Okay, everyone. Well, welcome to this CASA Agribusiness Breakthrough webinar. This is the second of a series of webinars featuring evidence and analysis by the CASA programme and partners to support the commercialisation of agriculture in emerging markets across the developing world. The webinars are designed to showcase solutions to the most common challenges in agribusiness for inclusive growth. And support investment in agriculture in emerging markets. The webinars take place on the last Wednesday of each month, and the first webinar in October featured evidence on the impact of concessional finance and the role of government in agri-financing. You can catch up with that recording on the CASA website. This webinar features reports on rethinking the different types of finance available and the role of technical assistance. It draws on 2 reports and highlights 2 case studies. We'll have presentations from people from 2 organisations. Firstly, we'll have Laura Amaya from FSG, and then we'll have Olivia Elliott and Abigail Thompson from the CASA Technical Assistance Facility. We'll have time for questions after their 2 presentations. Please post your questions in the chat and we'll pick those up. If you would like to ask the question individually, then please flag that in the chat and we'll aim to unmute you. So either way is possible, either by texting us in the chat or by flagging that you'd like to raise a question personally. If you do the second, you could just say where you're from and just give us an idea of the question. That would be helpful. So first of all, I'd like to introduce you to Laura Amaya from FSG. FSG is a mission-driven non-profit organisation working with foundations, businesses and impact investors to advance inclusive growth in markets around the world. Laura is an associate director at FSG based in London. She advises clients on shared value strategies, impact investing and inclusive business models across a range of sectors. So over to you, Laura.
Thank you, Alice, and thanks everybody for listening in. So very briefly, hopefully in just about 10 minutes, I will talk about a report that we published earlier this year at FSG titled Bending the Arc. It was developed in partnership with the Bill and Melinda Gates Foundation and with the UK's Department for International Development, now the FCDO. And Simon, I've seen that you've joined the audience. Simon was part of the group that co-developed the report. And it was co-authored with 2 of my colleagues at FSG, Harvey Coe and Johan Tuard, as well as developed with the support of a broader team at FSG that contributed with research and analysis. If we could go to the next slide. I just wanted to touch briefly on, thank you, on the focus for our research. And the research question we started with is how can we deploy the full spectrum of capital to enable inclusive growth in agriculture? And I guess the question that we had is why focus on inclusive growth? Well, in our experience and in that of the Gates Foundation and of the team at the Department for International Development, we saw that there were, in many markets, the parts of the markets that were growing tended not to be as inclusive. And the parts of the market that were inclusive tended to not be the ones that grew. So there was a disconnect between inclusion and growth. Now, there was also an added challenge in terms of the problem being siloed. The players were siloed, the instruments were and are siloed, and very few people are really thinking about both sides of the equation, inclusion and growth. So with this premise, we embarked on a case study research process. We looked at 5 case studies in agriculture across sub-Saharan Africa. 3 were focused on individual enterprises. So there's Ethio Chicken in Ethiopia, the Gulu Agricultural Development Company in Uganda, and Babangona in Nigeria. And then 2 of our case studies were focused on entire markets. So the mango sector in Burkina Faso, and the dairy sector in Kenya. And so we looked into these case studies to understand how investment capital, commercial capital, sub-commercial or concessional capital, and grants had been deployed to support inclusive growth. If we could go to the next slide, what we found in our research was that there were sort of two pathways for inclusive growth that were emerging from the different case studies. One pathway, which you can see on the left, is the one we call disrupt and grow, which is where an individual enterprise adopts a disruptive model in a market that is largely untapped, and so establishes a new model, a new way of doing things that later entrants follow or adapt and continue to build on. That's one, and that has really been the focus of a lot of the impact sector over the last few years. Now, we also observed a second and perhaps a more ambitious pathway, which you can see on the right-hand side, and we call this one guide and shift. And what this one is really about is that it focuses on a collection of smaller enterprises. They aren't as high growth driven, they aren't necessarily as disruptive. They're typically small and medium enterprises that, with the encouragement and with the support of external actors, adopt more inclusive practices. And so as more and more enterprises adopt inclusive practices, they shift market norms effectively towards greater inclusion, to the point that actually market leaders or large corporates adopt these practices as part of their core business. Now, this one is harder to do and it takes a little bit longer, but it can lead to deeper transformations, and we'll see a little bit more about this in a few moments. If we go to the next slide, we saw, going back to the challenge of how to deploy capital effectively to support inclusive growth, we saw that capital could help advance inclusion, which you see in green on the left-hand side, or help advance growth, which you see in blue on the right-hand side. And this could happen at the enterprise level, that sort of box in the middle, or it could happen at the ecosystem level, where capital is deployed to other actors that are not enterprises. So NGO partners, local banks, perhaps enterprises, but not in the same market. And so within both inclusion and growth, what we saw was that capital could target different levers. You see the 6 of them on the screen. So first one, develop and refine models. The second one, expand participation. The third one, entrench inclusion. Those are on the inclusion side. And then on the growth side, the 4th lever is the fuel growth. The 5th lever is to strengthen capacities. And the 6th lever is to encourage investment. And I'll share more about this in the next slide. So what we did in our research, is that we analyzed over 80 transactions that had been present across our case studies. And we saw some patterns in how different types of capital were best positioned to target different levers of inclusion and of growth. And actually, some transactions targeted multiple levers, sometimes across both inclusion and growth, as we'll see. So really interesting, on the left-hand side, the spider chart on the left focuses on grants. And grants are particularly powerful at moving the needle on inclusion, targeting levers that commercial capital tends not to target. So, for example, the use of grants to develop and refine models shows the utility of such kind of capital in scenarios that are highly uncertain, they're early stage, inclusive business models have not yet been proven, and therefore the financial payoffs are less clear. Another example is with expand participation, which you can see sort of on the left, pointing towards the left, where the use of grant reflects the fact that bringing more smallholders into participation in value chains has a strong element of sort of public good creation. And so grants here were applied both at the enterprise level, things like farmer training, and at the ecosystem level. So with ecosystem level initiatives that targeted a broader segment of either enterprises or smallholder farmers. Now, by contrast, and we see this in the right-hand side of the slide, we saw that commercial capital really focused on what it is best at, which is fueling growth. And this is consistent with how and with where commercial capital would naturally play And I think it also underscores the complementarity of the different types of capital needed to enable inclusive growth. What was perhaps most interesting was the chart in the middle, which highlights sub-commercial capital or concessional capital, which we saw could advance both inclusion and growth, oftentimes in the same transaction. So we saw sub-commercial capital often used to strengthen capacities of enterprises, often in the earlier stages of an enterprise's journey. And this demonstrates the importance of financial concessions to help enterprises build their financial, their operational track records. We also saw that most of these investments target the fuel growth lever. So you can see it sort of like top right of the chart. And this aligns again with the ambition of this type of capital to generate returns, even if they are not market rate. And then in both instances, we saw that sub-commercial capital also advanced inclusion, particularly by providing finance and inputs that expanded the participation of smallholders in improved value chains. And again, this aligns with the motivations of most concessional investors who deploy capital in service or with the intention of achieving greater inclusion. So in this context, blended finance is one tool in a broader toolkit. It is not the only tool. And I think this chart of sub-commercial capital really shows the other ways in which not just sub-commercial capital, but as grant on the left and commercial on the right can be deployed with different objectives. Now, one of the things that was really interesting is that some of the levers in the framework were not targeted as frequently. So only 2 grants and 5 sub-commercial transactions across the over 80 transactions that we evaluated worked to entrench inclusion. You can see that on the bottom left of each chart. But as I'll share in a moment, their impact was really transformative. Similarly, only a handful of grants and sub-commercial investments focused on encouraging investment directly, but again, their impact was considerable. And I'll move to these now, if we can advance to the next slide. Thank you. So again, you can download the report on our website. I believe the CASA webinar website also has a link to the report, but there were 4 highlights that I wanted to elevate from the report. The first one is that at the enterprise level, progressing towards commercial capital is not necessarily a sort of linear journey. And that's not necessarily a bad thing. In fact, we saw multiple instances of what we called positive non-linearity. So for example, when enterprises evolve in the nature and in the level of concessionality across transactions, perhaps moving to larger ticket sizes, moving closer to market rate returns. Another example is when grants are deployed later in an enterprise's journey, but they're deployed for highly catalytic activities that have uncertain returns, and so that an enterprise wouldn't necessarily be willing to take a risk on or would be able to take a risk on, or for activities that result in public goods like smallholder farmer training, and so that could create an element of sort of lack of competition mentality. And so I think what we landed at is that there's a better construct for graduation to commercial capital, which is actually progression. As long as the enterprise is moving in that direction, it is still okay to receive grants or sub-commercial capital later on in its journey. The second highlight that I wanted to bring to light in this presentation is that grant or sub-commercial capital can be used to entrench inclusion into models and into markets. And what we mean by entrenching inclusion is really safeguarding against the risk of inclusion being eroded or inclusion impact regressing as an enterprise or as a market moves towards greater volumes of commercial capital and therefore faces different kinds of pressure. So again, a couple of examples of these. One could be to provide incentives in the type of sub-commercial or grant capital deployed to achieve greater inclusion. So we saw in the case study of Babangona, they received a loan that had impact-linked interest rates. And so they rewarded greater inclusion impact with lower interest rates. Another really interesting example is ensuring the permanence of inclusive practices. So in the case of Babangona, again, using grant to transfer part of the ownership in the company to a smallholder farmer trust. So that ensures that the interests of the would-be beneficiaries are always at the forefront, and they have actually board representation and have actually strong presence in the governance structure of the company. The third insight is that market level approaches, yes, they have longer timelines, but they also have potential for impact at a greater scale. So the time horizons across the board to mobilizing commercial capital are longer than most investors are used to, even than most impact-oriented investors. And this is true for both enterprises and for markets. But in markets, this is even more intense. So when you think about a sector level, with timelines of 1 to 2 decades. So a really good example is the case of the dairy sector transformation in Kenya, which has taken so far just over 2 decades. But it has impacted 1.8 million smallholder farmers across the country. And that is over 10 times higher than the impacts that individual enterprises, which have in themselves been very impactful, achieved. And finally, the fourth one is the real push to engage local financial ecosystems as a way of mobilizing commercial capital in the long term. And Olivia will touch a little bit on this during her presentation as well. So through our research, again, just a couple of examples to give you a flavor of how this plays out. We observed 2 approaches. The first one was working with existing financial institutions, so incentivizing them to move into different segments through the use of things like first loss guarantees, like subsidies, like technical assistance. And we recognize that this is an ongoing field of practice and of research, so there are still a lot of lessons to be learned. The other approach is supporting the development of challenger banks or challenger financial institutions, which are essentially new financial institutions that challenge the incumbents in a market. And so the approach here can be to support them with grants, with loans, with equity, with technical assistance, to be able to grow into significant players in the local financial ecosystem. Again, the fascinating case of dairy in Kenya was that it evolved as the Kenyan financial ecosystem evolved. And so there were a number of financial institutions moving towards smallholder lending, moving towards new enterprise capital provision. And that was really critical to mobilizing high volumes of commercial capital towards inclusive growth. Just to wrap up, and I know I've taken slightly a little bit more than my allocation, so Olivia, apologies for that. I just wanted to leave you with 3 sort of big lessons and ideas for practice. Ideas for practice, if we move to the next slide, you will be able to see at the bottom of the slide. So the 3 lessons are: first, think about what is the appropriate capital mix against the sort of desired levers. So really to be intentional about what is it that a transaction aims to do, and then thinking about what is the right kind of capital to do that. It could sort of work either way. And part of that is recognizing that the transition won't necessarily be linear. So even though a company might already be accessing commercial capital, there might still be a role for grants or for concessional or sub-commercial capital. The second big lesson is to place a greater focus on entrenching inclusion. So making sure that inclusion is a priority for businesses, not just an aspiration, but actually in terms of the ability for businesses to keep inclusion outcomes at the forefront, even as they move towards more commercial capital. And then finally, a push to focus on the ecosystem, not just the enterprises. So really think about what are the specific needs of a diversity of enterprises, what are their preferences, and tailor the approach to that. And I think this is a good segue to the couple of case studies that Olivia will talk about now. Thank you.
Thank you very much, Laura. That was extremely useful and a very good summary of a very good report, the Bending the Arc. So please do go and take a look at that report, everybody who's here. We'll save questions till the Q&A at the end. So I wanted to pass on, as Laura said, this segues very well into the detailed case studies that Olivia Elliott and Abigail Thompson from CASA's Technical Assistance Facility are going to talk us through. The CASA Technical Assistance Facility supports agribusinesses that source from smallholder farmers. Their approach is to conduct a deep dive into the business to draw up an inclusive business plan, and we'll hear more about those in Olivia and Abigail's presentation. A roadmap basically for the agribusiness to deepen or broaden its supply chain so that it can deliver commercial and social value to smallholders and shareholders. So we'll hear about a couple of those examples of CASA technical assistance activities. First of all, we'll hear from Olivia Elliott, who consults for is the learning and evidence lead for CASA's technical assistance facility, and also consults for IFC's Agribusiness Advisory Services and FCDO's Food Trade East and Southern Africa programme. And then we'll hear from Abigail Thompson to sum up, and she's the team lead of the CASA Technical Assistance Facility, and as a programme director at TechnoServe, Abigail has been overseeing technical assistance programmes alongside investment funds for several years. So looking forward to hearing some of the details of your case studies. Over to you, Olivia.
Thanks, Alice. So I'm going to try and squeeze in 2 case studies into the next 10 minutes, building on what Laura's already shared. They're both examples of smallholder sourcing companies, and they demonstrate exactly what Laura was talking about, how technical assistance grants alongside commercial capital can really enhance commercial value and development impact. And it's worth pointing out at this point that we're on a journey with these businesses. So we're working with them at the moment. I don't have perfect end-line results to share with you today, but we're very much testing and refining our interventions as we go. So Myron, we can skip through the next slide, or maybe even the next one after that. Yeah, the next slide, please. Perfect. So the first example is a dairy company in India. India is the largest producer of dairy in the world, so it's really important for rural households, making up a third of gross income. So the sector has a really important role to play in both economic growth and poverty alleviation. But like many sectors in agriculture, smallholders are often subjected to manipulation by middlemen. We're working with Osam Dairy, which is a vertically integrated dairy business selling milk and milk products, which you can see in the picture on this slide. Osam is one of CDC's investee companies, and CDC is one of our investor partners at the CASA TAF. Osam is sourcing from 23,000 smallholders in some of the poorest areas of India. So a survey recently conducted by 60 Decibels found that almost 3/4 of farmers are living below the poverty line for a middle income country, and 1/4 of farmers are living in extreme poverty. So in July last year, the company engaged the CASA TAF because they wanted a step change in volumes in some of their high potential villages. This presented an opportunity for both commercial value and social impact. So we conducted a rapid diagnostic, which we call an inclusive business plan, and co-created technical assistance interventions with the company management, designed to both increase market share and benefit smallholder farmers. So we can skip to the next slide. Thank you. So our interventions are piloting a bundled procurement model. This is both expanding digital collection and payment, something that had already been trialed by the company with a grant from the Gates Foundation. And we're also introducing farmer extension and input support at 5 milk collection centres. Our inclusive business plan estimated that the impact created would be £123 per smallholder farmer per year by the end of the project in incremental income. That's for 2,400 farmers, so around £1.3 million in total incremental income. That's 12 times the investment that we're making as CASA TAF in the project. We can skip to the next slide. So I'm just going to give a bit of detail on exactly how the digitalization works. So we believe there's a really strong need for technology in the dairy industry as a whole, but especially in emerging markets where yields are low, quality is poor, and often traceability is inadequate. So we're working with Osam to democratize pricing in the sector. by introducing payments based on quality. So essentially how this works, I'm going to take you through these boxes on the slide. They go left to right, then right to left. The farmer arrives at the milk collection centre, their ID card is scanned, and then the milk is analysed and weighed digitally using some Stellap's technology. This quality adjusted rate per litre is determined using the company rate card, and all the data is stored in the cloud, but it's then available for the farmer to see at the milk collection centre then and there. So it's completely transparent how that price is calculated. The farmer is then paid directly into their bank account within an hour of the milk arriving at the milk collection centre. So the farmer is getting payment based on quality, they're getting faster payments, and the company is able to source directly from farmers, cutting out the middleman. We believe that dairy in India, like Laura talked about, dairy in Kenya, could also be an example of the guide and shift pathway. So with encouragement from external actors, companies like Osam can adopt inclusive practices, and the whole sector can move towards being more inclusive. So for example, other companies in the industry might also take on democratizing pricing for the whole sector. So we can move to the next slide. So I'm afraid it's impossible to attend a webinar these days without talking about the quite catastrophic impact of the coronavirus pandemic has had on agribusinesses around the world, and Osam is no different. So I'm sure some of you know, at the end of March, Prime Minister Modi introduced a national lockdown in India, which led to a 35% decrease in sales of fresh milk. FCDO, who is our funding partner, adapted quickly to this challenge and approved an addition to our strategy. So the CASA TAF is now not only providing inclusive technical assistance, but also core technical assistance to enable us to support inclusive businesses in their operations and also to sustain smallholder farmer jobs. So in collaboration with the company management, we designed a new technical assistance intervention to convert the daily milk surplus into milk powder, which could be sold at a later date. CDC Plus has been funding this project, and CASA TAF has been managing and monitoring it. The results so far are really promising. So approximately 3,000 smallholders have been impacted, receiving around about a 5% increase in the price of milk they receive, and at a time when we expected the price of milk to decrease. And over 60,000 litres of milk have been converted into powder and ghee. We're also working with the company on a route to market strategy to enable them to explore different avenues. So for example, contactless home deliveries. We can skip to the next slide, which is the next company. So the next example I'm going to share with you is also an Indian business, but it's in a very different sector. So DeHaat is an agri-tech company which offers input sales, advisory, and output purchase to over 300,000 farmers. DeHaat has been invested in by Omnivore, which is a specialist agri-tech VC fund, and they invested in 2019. Omnivore is one of CDC's intermediary funds. So as you can see from this slide, a lot of about 30% of the crops that farmers are supplying are cash crops like wheat, maize, and rice. And we believe this could be a real example of the disrupt and grow pathway that Laura talked about. The company is aiming to reach 17 million farmers over the next 5 years, and they're looking to expand into financial services to both deepen their impact with each smallholder and also increase output sales. So we can move to the next slide. So if I'm to give you a bit of context, if we're to step back, at the moment, looking at the financial services ecosystem in India, less than half of Indian farmers have access to formal credit, and 40% of those are through informal sources. So, I mean, just if you look at this table on the slide, you can see informal loans from money lenders, the interest rates go up to sort of 50%, and from MFIs, it can be as high as 40% as well. So DeHaat recognized they had an opportunity by leveraging the demographic, landholding, and agronomic data that the company holds to design financial products that were really tailored to the farmer's needs. So we can move to the next slide. Thanks, Mohan. We're working with DeHaat now to address access to finance through an input credit scheme, which is enabling farmers to purchase inputs on credit with repayments linked to the harvest cycle. So we hope this will enable farmers to increase their yield and benefit from access to lower interest rates, while the company will benefit from increased input and output sales, but also an increase in farmer loyalty and an increase in competitiveness. As I said right at the beginning, we're very much in pilot mode. So we're testing and refining the model as we go. So we're starting off working with 5 crop cycles over the next 16 months, starting this month with wheat. And we're working with a new financial institution, which will loan direct to farmers. So our inclusive business plan estimates that this intervention has the potential to impact 48,000 smallholder beneficiaries with an income increase of £177 per smallholder per year by the end of the project. So that's a total of £11 million, which is over 150 times the investment being made in the project by CASA TAF. We believe that DeHaat, as I said before, it could be a real example of this disrupt and grow pathway. It's a highly disruptive business building new pathways along smallholder inclusive supply chains. But I guess the question for me is, will this impact remain exclusive to DeHaat, or will other companies be able to come in and replicate the model? And I guess only time will tell us that. I'm going to hand over to Abby now, who will summarize a few takeaways, and we can move to the next slide. Thanks.
Thanks, Olivia. I'm going to anticipate a challenge from the audience here, which is to ask, how do we make sure that these enterprise level interventions have a systemic impact? So one approach that we're taking is to intentionally transfer the knowledge and the business model innovations from one place to another. Now, of course, we've got to be careful within a country and a sector to respect competition boundaries between companies that we work with. But by working across multiple geographies, we've got an opportunity to transfer innovations across countries and even continents. So what works well as a technology for Osam in India, for example, could also be a great innovation for the dairy sector in Kenya, where we're also working and where, as Laura pointed out, there's still an opportunity to grow and be more inclusive. So the other approach we're taking is to draw insights from the diversity of inclusive business models we engage with, to comment on this appropriate mix of capital to enhance inclusivity. Laura also touched on that in her presentation, because some businesses that we work with require a heavy lift to shift into a new model, especially when the commercial opportunity from being more inclusive is not significantly attractive. Some might just need a skills or capital nudge, though, to try out a new model, because the potential return could be so great in terms of the cost savings from procuring from smallholders or gaining more market share, for example. So we take a 5-year horizon when we do these calculations in our inclusive business plans, and we work back from that figure to determine what an appropriate financing split between commercial and grant capital is. So we don't take the kind of cookie cutter approach to cost share and determine that for each project it should be 30% or 50%. We're looking at that bigger picture, and then we're trying to determine what really is the kind of combined commercial, sub-commercial and grant capital required. So yeah, finally, I just want to comment that there's a reason that CASA TAF has taken this strategy of partnering with investors first, and then identifying businesses within their portfolios to work with. So our strategy is to bring the investors along on this journey of inclusive business modeling and technical assistance design, so that we can leverage their investment and they can leverage our catalytic grants when it comes to implementing. Overall, we're aiming to raise the expectations of what can be achieved from this combination of commercial and grant capital, and as a result, see more coordinated combinations of capital to create this growth and inclusivity. So look forward to any questions on that and the way that we're operating.
Thank you very much, Olivia and Abigail. Really interesting to see and very powerful numbers in terms of the impacts, and also how you're planning to entrench those and make sure they continue through the activities that you're doing. And just to remind everybody that a recording of this webinar will be available on the CASA website after we finished. And to remind you that please do ask some questions on the chat if you'd like to. I wanted to just start with a question which really leads from where you were highlighting some issues there, Abigail, about how do you make sure that there's an alignment between your investors, the people who are in the enterprises and the people who you're working with, those companies, and the people who are the donors and wanting the impact? I think this is a big challenge around, and you highlighted some of the ways that does happen, but what are the primary things that you think to look out for when you're wanting that alignment between a company and its inclusive business strategy?
Yeah, I think what we're seeing in development in general, or at least in the time that I've been working, the last 10 years, is that there's been one trend which is around increasing approaches in market systems development. So donors taking that approach of setting up programs, intervening in sectors and sort of trying to raise that tide for all ships. But there's another trend that I think is a bit more recent, which is around the development and donor money being deployed alongside investment, as we're an example of, I think, where you're really looking for that leverage of private capital and looking to sort of move the needle on certain business models and have a demonstration effect then in a sector. I think that there's room for both approaches, and what we also see as we kind of implement these projects with businesses is that there's quite a lot of coordination even between the two types of development capital. So in fact, what we have found is that we're often a very minority share of the cost share into an inclusive business model, and that's partly because we can demonstrate that there's an opportunity, a commercial opportunity, so sort of business finance, but there's also been sector development capital deployed in that sector previously that has already sort of shifted things. So I think it's not to say that one or other approach is sort of better than the other. It's just about kind of joining it up and coordinating. But it is particularly important, I think, when we are in the deploying alongside investors, that we do respect things like confidentiality and commercial principles. So I think that that's where we often look for a high degree of intentional coordination, where we set up steering committees, for example, between different investors into one business, the business itself and ourselves, as well as then occasionally having kind of broader stakeholder meetings around the sector subject that involves other partners.
Fantastic. And Laura, from your three graphs around what each type of capital is expected to bring, it looks like there is real complementarity, whether it's the disrupt and grow model or the guide and shift model, around how those different types of capital bring different things to the party. So talk a little bit more about how you see that working, that partnership really between the company and the TA.
Yeah, absolutely. And I think what you said first is really important. There's real complementarity between different kinds of capital and different types of investors, and they don't always need to work in coordination as long as they're building on what each other has helped the enterprise do. So I think a big role is actually for investors or grant providers to listen to enterprises. I think I shared a little bit about this, and Olivia mentioned some of it in the two case studies that she shared. Understanding what specifically an enterprise needs in order to advance inclusion whilst keeping a focus on growth and being able to deploy the right kind of capital for that. That might mean some investors can start at the enterprise level and then pull from different tools that they have at their disposal. For investors or for grant providers that only have a limited number of instruments that they're able to deploy, it might mean understanding where they can be most impactful. So trying to identify enterprises that could benefit from that kind of support. I think the other thing that is fascinating, that was fascinating from our research, was seeing how, if you remember, we have sort of 6 levers in our framework, how individual transactions could target multiple of those levers at once. So I think that the key here is, of course, there needs to be complementarity across investors and across transactions, but a single transaction could also help the enterprise advance in different dimensions.
Yeah, no, I think that's really important, and it plays into also the point that came out in your report about it's not a sequential piece. It could, different parts can be relevant at different stages of the journey, and I wonder from the CASA inclusive business practice, sort of what you've learnt about that. Obviously, COVID threw a lot into confusion. So we were taken back to needing support core business, but other examples of where you've seen businesses deploying TA to support their inclusive business growth at different stages.
Thanks, Alice. Yeah, we have been on a bit of a journey with COVID in terms of sequencing of TA. I think one of the big findings from the implementation of the Africa Agriculture Fund's technical assistance facility that TechnoServe managed from 2011 to 2018 was that this upfront analysis phase of 3 months is incredibly important to define what the opportunity is going to be, and then to be able to right size the technical assistance and the amount of kind of grant alongside investment that is required. But of course, with COVID and businesses then being so disrupted in a core business sense, for example, their markets being shrinking or prices for products dropping by half, they're having to sort of pivot and adapt really quickly, and it might not be the best time to engage. Sometimes it is actually, because they do need to think about their business and model again, but there's other immediate needs that they have. So that was the sort of rationale behind pivoting and being able to do more core business support. But we've also recently proposed a further adaptation, which is to be able to do some core business, inclusive business support prior to or in parallel to our IBP process, because there's just such an urgent need from smallholders who have also kind of had this like follow-on impact as a result of the disruption to the business and to their market. So yeah, I think that it's been a difficult year on that front. Agriculture in general, though, does face these kind of this volatile environment, and therefore I think flexibility is quite key here. And being able to do, maintain a kind of a focus on this analysis being important for that bigger picture and a kind of 5-year plan, but also on addressing immediate challenges.
Yeah, no, absolutely. And I think it's really interesting to see the way that donors who are looking for that impact outcome and investors, enterprises who really just want to be able to get survive and grow and employ people and have customers, how those two work together in partnership. And I'm wondering that the piece that was mentioned around it's what's very important to move from the disrupt and grow perhaps to the guide and shift is that intentional learning, and that's that knowledge sharing across different groups. And you mentioned about the importance of respecting competition, but I wonder if you can just expand on that a little more, both from the FSG perspective and from the CASA technical assistance perspective, on how you see donors supporting that process, but with being very respectful of the boundaries that they need to be conscious of. Perhaps Laura go first, and then we'll come back to CASA after that. So that knowledge sharing, that learning to bring the whole market with the enterprise and move to that very large impact that you were outlining from your report.
Yeah, thank you, Alice. I think it's a really important point because, and Olivia and Abigail might touch on this in a few moments, but there is intentional knowledge sharing, and so that needs to take into account competition, and then there is informal knowledge sharing. And so one of the things we saw in particular in the disrupt and growth pathway was enterprises weren't putting out their business model for everyone to see, but they were doing things. They were embedding certain inclusive practices like paying the sort of fair price, quality-based payments, farmer training, additional input technical assistance, etc. And they were doing that to gain a competitive edge over other players in the market. It could have been larger players, it could have been players in the same area. And so just that, just facilitating that ability for a company to act in a different way already sends a signal to other players in the market. And one of the premises of the guide and shift pathway is that the more, as you get to a critical mass of companies that are adopting these inclusive practices, other companies, if they don't adopt them, they will lose out in the market. And so there's really sort of grounds up pressure, which is slightly different from, Abigail, we were talking about the market system development approaches, which are more about intentional knowledge sharing and facilitating. So I think it can happen both ways. In Kenya in particular, there was a lot of the grounds up pressure, but there were large donors like the Bill and Melinda Gates Foundation, like DFID, like USAID, who created a sort of market system development framework that could support shared activities, shared knowledge. And so I think there's a role for complementing intentional and informal knowledge sharing.
Fantastic. No, thank you, Laura. And I'm interested in from the CASA Technical Assistance Programme whether you agree what that intentional knowledge sharing is going to be with the enterprises that you're working with early on, so that's very open, that's very clear when you first go in, or does it evolve? How does that work in practice?
Yeah, I mean, it's very hard because obviously we don't know what the outcomes are going to be when we start working with the business. So I think it's more sort of a work in progress, and as we get results, that's at the moment when we share, rather than sort of trying to share expected results. I was just going to add as well on the types of learning partners that we're working with at CASA TAF. So obviously, as Abby shared earlier, we're working with 7 investor partners and also learning investor partners, but obviously that's just a drop in the ocean of in the grand scheme of things of investors in these areas. But we're trying to work with different types of investor categories. So we're not just working with European DFIs. We're also, as well as working with investors like CDC and FMO, we're also working with smaller impact investors like DOB Equity, which, although they're a small private Dutch family foundation, they're very influential in the impact investing market in East Africa, which is growing. And then we're also working with companies like Barak Fund. So we try to reach sort of a broad spectrum by picking partners that are influential within their sort of spheres of influence. And the types of sort of, we're producing learning products like an annual learning paper and case studies on the businesses that we're working with that will be public. But for me, the thing that's most important is events like this one, but also events. So we have an agriculture TA working group that's really important for practitioners to be able to share their experiences, share what's working, what's not working, the challenges that they're having. And we're finding that we're facing very similar challenges. So we work very closely with the IDH Farm Fit as well, and finding that we can sort of brainstorm together on issues. So yeah, that's what I'd sort of.
Yeah. No, perfect. And in terms of that that sharing information and driving real change, I wonder whether you ever you find that because you're sharing that learning, have you yet seen a shortening of the time frame for? It's a bit early days, but the ideal we're all working towards, I suppose, is to say here are some models that actually do work to combine that commercial and that inclusive perspective. Did you see that, for example, in the cases that you were looking at, Laura, in your report? Did you see evidence that even the companies that you're working with were beginning to go, well, we clearly think that there is even more of a business case here than we had before, or that there was learning that came out of it that people can build on? And I'll come to Abby and Olivia afterwards when you've just commented on that. Are we making progress towards that combination of commercial and inclusive models?
Yeah, that's a really good question. I think in terms of the businesses themselves, I'd say a lot of them were learning from other peers, be it in the same industry, so a sort of like competitive push, we have to do this, or learning from players in the same industry but in a different market. So Olivia, you talked about how Osam in India could learn from the Kenyan dairy sector or vice versa. So that there was a lot of that happening. And I think it's really powerful. I mean, to just echo one of the things that Olivia said, how do we help businesses and investors not have to reinvent the wheel, each one within their 4 walls, but actually borrow on what each other was doing? One of the best examples that we found in our research was probably the dairy sector in Kenya, where there were, even before the focus on individual enterprises, there were these large market shaping efforts conducted by global donors. And it was really fascinating to see how each one took the time to understand what others were doing and building on those, sort of plugging in where there were remaining gaps. I think that is often the intention, not often the result. But I think being open to that learning, and I think the more we can as practitioners exchange learnings and facilitate sharing our own knowledge with others, we'll be able to shorten that sort of innovation curve and open room for greater creativity, building on what everyone else sort of has tried and tested.
Indeed, no, absolutely. And just a final comment from you, Abby and Olivia, around that, and how you're making sure that those models are entrenched, as we heard from the FSG research, really important to, when you leave and your TA is no longer available, making sure that that lasts. And obviously, if you've proven the business model, then the game is an easy one. But just comment on that element as well.
Yeah. I think that's why we've been quite intentional about working with, particularly for our anchor investor partners that are basically DFIs, so CDC and FMO so far, that they actually do have technical assistance allocations already. So, you know, they're doing some of this, but as our landscaping of DFI technical assistance study showed that we recently published, a lot of that is still focused on core business support rather than inclusive business support. So I think what we're looking to do really is to sort of influence like how that existing resource is allocated. So potentially being a bit more ambitious and extending into more inclusive TA, but also increasing the overall size of the pot, which, as I said, one of the trends in our favor is the fact that the blended finance is, you know, kind of very kind of hot topic. And I think there are more kind of donors that are considering putting more money into those types of schemes alongside investment. But that's not actually the Holy Grail. The Holy Grail would be for investors to experience the commercial opportunity and returns from more inclusive business models. And then, you know, from that profit that they can make, that increased return, allocate more into sort of the technical assistance or that, you know, catalytic grant pot. And then that would then be a sort of more sustainable resource. So as the overall kind of capital markets grow, so is this grant portion alongside it. So I do think that, you know, that's what we're also trying to be able to show. And one of our partners, Barak Fund, recently had a call with them on their technical assistance facility that they're just setting up, where they have projected that they would be returning some of their profits from their investments into the TAF so that it's an evergreen facility.
Yeah. No, fantastic. Well, that is absolutely where we're trying to head. And it sounds like great progress from all of the work that's being done on that, and so it's really great to hear how that's panning out, and it sounds like we are going in the right direction. So thank you all so very much for joining us. I wanted just to say a final thank you to obviously to our panelists, to Laura Amaya from FSG, to Olivia Elliott and Abigail Thompson from CASA's Technical Assistance Facility, and to all of you for joining. Also to FSDO for supporting the CASA programme. And just to highlight that the next webinar is on the 27th of January. We haven't got one in December for obvious reasons. The last Wednesday of December, we're all busy with other things, but we're looking forward very much to reconvening in January. And as we say, the recording of this webinar will be available on the CASA website, so please do check it out there. But I think just in closing, I think we know that technical assistance can be deployed at various different stages in a business to really drive that inclusive business models. I think the work that is being done and the case studies that have been illustrated, I think show the different ways in which and the different timescales over which it can be deployed to really develop not just an enterprise focus, but also a market focus on inclusive business. So many thanks to you all, and many thanks for joining, and look forward to catching up with you all perhaps at the next webinar in January.
Thank you, Alice, and thank you, everybody.
Thank you, Alice.
Thank you, Abby.